All right, people, welcome to this new chapter, the basics of capital budgeting. Well, this topic has been covered in our accounting class before. I still feel it is necessary to bring the content in this finance course. The bottom line of capital budgeting is to determine whether a business project is acceptable, whether you're going to spend a lot of money to start the project or you just reject the project and consider other options. Okay, so of course, if you launch a new business project, you're going to invest a lot of money in the fixed assets. The fixed assets could include land, building, property, plants, equipment, vehicles, all right, and that's a lot of money, so you have to be careful about spending it. And it's usually about long-term decisions. We're talking about not just 3 months or 5 months. We're talking about 5 years, 10 years, or even 20 years. And also, it's very important to a firm's future. So the project may not just limited to a new store or a new factory. It could also be buying an existing company or launch a joint venture with a local company in another country. So you have all forms of business projects being considered here. Okay, so from the previous chapter 10, which is on weighted average cost of capital, we learned that in order to attract investors' money to start your business, you have to pay investors a return in the form of dividends to the equity investors, and you pay interest to the debt investors. So dividends could be divided into preferred common dividends, and interest could be reflected in coupon payments and face value of bond. All right, and the WACC, the overall financing cost, so the cost of raising capital to run the firm. So let's say if you want to at least maintain a break-even situation, you want your revenue to at least match the cost to keep the firm running. Okay, if you want to collect $100 million capital, and the firm needs to pay $15 million per year to its investors, then the overall cost of capital would be 15%. And then the firm would require its business to have at least 15% or higher every year to recoup the cost. So the desirable returns would be over 15%, like 16, 20, 25, or 30. All right, so if a business can give a return that is lower than the cost of capital of 15%, then the firm should abandon the project. Okay, so you always seek the project that would give you higher return, a return that is higher than the cost of capital. All right, so the financing cost is, well, like interest and dividends. These are in cash forms, but we do not incorporate those cash flows in the free cash flow calculation. All right, it sounds a little bit wordy, but you should know that when the firm pays dividends, when the firm pays interest or coupons, the face value, any money paid to investors, we are going to convert them in the cost of capital. Okay, this is from your chapter 10. And the cost of capital is not in dollar format. It is actually a percentage. Okay, so all the money paid to investors will be converted into a percentage in the overall cost of capital for the firm. And then you use that percentage, use that rate to discount the cash flows. So if you pay more money to investors, then you would discount the revenue by more. And the cost of capital here serves as a required return for the firm. Okay, so if you look at the profitability method, we will use the NPV. Okay, in this case, the NPV equals to the summation of all future cash flows discounted to today's dollar minus your initial investment today. Okay, the NPV formula, this is what we had before for chapter 9 and chapter 5. It does not incorporate a upfront capital expenditure. So in the new chapter of capital budgeting, we're gonna use the formula on the right. Okay, so the cash flow zero, the cash flow today is negative, and the investment needs to be made at the beginning. Okay, in our previous case for stock valuation, the cash flow zero was zero, so we did not really have a place for cash flow zero. Okay, the rationale for the NPV method is to get the present value of all cash inflows generated by this business project subtracted by the initial cost. So you would get the net gain in wealth. And if the projects are independent, you accept if the project has a positive NPV. Okay, so you may face a different projects. You may run a food store, you may run a sign store, or a candy store, different stores. Okay, so each store is a project. If these stores are independent from each other, that means opening one or shutting one has nothing to do with opening or shutting another. Um, so that's called independent. So you also have projects that are mutually exclusive. So mutually exclusive means the two stores cannot be run together. Like you have one factory that runs organic fertilizer, and another factory runs ice cream. So these two things do not go very well. So you can choose one out of the two. You cannot choose both at that time. If that's the case, you just choose the project with the highest NPV. All right. So right here you have some numerical examples. You have a project L, and this is the cash flow generated for the next 3 years, 10, 60, and 80. Today it requires a $100 investment. The cost of capital is 10%. You're going to use 10% to discount all the cash flows. And you know that the 10% is made of the money paid to the investors. Okay, so you discount $10 by 1 year, you get a 9.09. You discount $60 by 2 years with a 10% rate, you get 49, and $80 discounted for 3 years with a 10% rate, you got 60. And then you add all this cash flow together. It's okay to do that because every dollar amount here is in today's dollar. It's on the same page. So you got a positive NPV. So you would accept that project just because NPV is greater than 0. Okay, so that's the Excel formula to do that, and you will do this in your Excel project number 7. Okay, and you can also put the cash flows in your calculator and utilize the NPV function. And for more details, you can check chapter 5, how to use your calculator to do NPV. All right, another method to measure the success of a project is the internal rate of return. The IRR basically is the discount rate that forces your NPV to be equal to 0. Okay, so that's basically give you an idea of a break even. Okay, so if you use the IRR as a discount rate for all the cash flows, and your cash flow starting from 0, which is today, of course, you're gonna put some investment there, and then in the future all the way up to year end. Okay, and the higher IRR indicates more revenue because a higher IRR would let's put it this way: if the cash flow is higher, then it would require higher return to discount the cash flows to the break-even point. Okay, so just remember that higher IRR indicates more revenue, or higher amount of cash flows would require a higher discount rate to get to break even. Okay, so if you use a financial calculator, that's what you need to do.